What's up guys, your boy Fuzal Tips, and I'm back again with another video. You know, every time you see me it's all about tips. Today I'm back to give you guys another amazing tip that you'll never forget. I know most of you watching are probably beginners, but today we are going to talk about candlestick pattern for beginner, all you need to know to get started. I know some of you must have been wondering, like, what is this stuff that I'm seeing on the chart? Yes, today we are going to talk about that. And first of all, we'll start about what candlesticks are, the type of candlesticks, their uses, and the different formation of candlestick patterns and where to identify them. So stay tuned to the end of this video, and if you find my videos interesting, make sure you give a thumb up, you subscribe, you comment down below, let me know what your questions are. If you doing all that, YouTube will see that people love these videos and they will send this video to a lot of people like you. So help me to help you more. First of all, let's define what are candlesticks. Candlesticks are just a visual representation of price action in a specific period of time. All right, so candlestick patterns are just technical indicators that represent price over a specific period of time. This is how a candlestick look like. It either look like this or like this. So let's break it down. There are two major type of candlestick: a green candlestick, which means a good one, and a red candlestick, which means a bad one. In other terms, you say a green candlestick is a bullish candlestick, which indicate that price went up, that people are buying, ready to sell high, which also indicate that there are more buyers than sellers. And the red candlestick indicates that market is selling, indicates that there are more sellers than buyers, so indicating that price will go down. So red candlestick represent bearishness and green candlestick represent bullishness. As we just said, bullishness means that people are buying an asset expecting prices to go up, and bearishness means people are selling an asset expecting price to drop. And yes, a candlestick consists of a high, a low, a body, a open, and a close. Every candlestick has all of those. Let's show you guys the main difference between a bullish and a bearish candlestick. So this is a bullish candlestick, and this is the body. Like we said, every candlestick has a body. This is the high, all right, this is the close, this is the open, and this is the low. Unlike the bearish candlestick, which is the red one, this is the high, this is the open, this is the body, and this is the close, this is the low. So the main difference between a bullish and a bearish candlestick is that a bullish candlestick open at the bottom and close at the top. So let's say it start at the bottom and it close at the top, right? Means that people bought down and price went up. Like we said, bullishness means that people are buying an asset expecting rise in price. Why a bearish candlestick is the one that opens at the top and close at the bottom, means that price went down. It means that people sold and price of that asset went down. Okay, those are just the two things that you need to know as a beginner. We also have something like candlestick pattern. Candlesticks pattern, you start seeing some different type of candles formation individually or multiple combined together that they have different meaning, and this is what you should know. First of all, let's start with the neutral candles. When we mean neutral, it means that the market didn't really go up or it didn't really go down, right? It means that the buyers and sellers are equal. It means that there is no amount of buyers that are more than sellers. So this means that the market doesn't have a direction yet. So this is how neutral candles look like. So a neutral candle, for instance, is a candle that open and close almost at the same place. There we call that a doji. Doji candle is like this. It opened right here. We don't actually know where it went to, where it started. It came here and formed a high, and then came down here, formed a low, ended up closing here, right? So this becomes indecision. Market doesn't have a direction that is moving. So again, you have a gravestone doji, which is also neutral. Unlike this, it opened right here, came here. There was a point in time where it was like this, and then it ended up closing exactly where it opened at. So you call this gravestone doji. And here you go with another one, a dragonfly doji, which opens right here, came like this. There was a point where it was looking like this, but it ended up closing here, telling you that the market hasn't really find its way yet. So okay, this is where you can find neutral candlesticks during the period of consolidation. I know consolidation is a new word to you. This is the period where market is not moving in a particular direction, it's just moving sideways as a beginner or as a trader, you don't trade when you see these candles, because we call this a choppy market. So market come up here, come down here, but it doesn't go anywhere. Come up here and take people's money, come down here and take people's money, ended up being the same place where it started as. So let's go to the good one first before we come to the bad one. Remember, it's not bad, but you know, red is obviously not good. Even though as traders you use all of these to make money, just depend what time and place you're using in the market. The bullish candlesticks pattern, right? So in the bullish candlestick patterns, we have single candlesticks patterns and we have multiple candlestick patterns. Let's start with the single ones. We have a hammer which looks like, ideally looks like a normal shape of a hammer that you have in your house or where you can buy at the store. A hammer is a potential bullish reversal candlestick pattern that happens towards or at the bottom of a downtrend. A downtrend means that price has been going down, falling. Now you identify hammers towards the bottom of that trend. To know that it is a hammer, the tail, which is the lower part of it, is, or the lower shadow, is usually at least twice the size of the body. You know, we told you guys every candle has a body, right? So this will be your hammer. And we also have an inverted hammer. Unlike a hammer, it's also a bullish reversal candlestick pattern that happens towards the end of a downtrend. And unlike a hammer, the higher shadows often twice the size of the real body. The reason why this candle is like this, because the buyers tried to push this candle to the upside, but there was not enough volume to get price up. But it's signifying that there is some type of demand, that there are some people ready to buy. And also, like a hammer, sellers try to suppress price and take price all the way to the downside, but they didn't have enough power to push that price, because buyers came in and be like, this our region, we are defending this, and that candle ended up closing like this. There was a point in time when this candle was looking like this, but it ended up like this because the buyers like, okay, now you've been taking us, now it's our turn to go up. So let's go to some double candlestick pattern. Have the bullish engulfing candle. It's a potential bullish reversal candle that happens towards the bottom of a downtrend, unlike a hammer. It's a two candlestick pattern that the body of the bullish candle fully engulf the size of the previous bearish candlestick. To identify a bullish engulfing candlestick pattern, there must have been an existing downtrend that has already occurred. This red candle being a candle that came from a downtrend with low momentum, and the next candle being a candle that happened when buyers step in and be like, okay, we're about to take charge. That is why we call them potential reversal candlestick pattern. And you see this towards the end of a downtrend. To really identify and to really characterize if this is a good engulfing candlestick pattern, it must be at the bottom of a downtrend. The low of this should be lower than the bearish one, and it must close above the high of this. If this have a higher wick, this closure should be above the high of that candlestick pattern. Chooser bottoms are potential bullish reversal candlestick pattern that forms towards the end of a downtrend. This happen where the bottoms are slightly or almost the same. This candlestick came from a downtrend and it ended up closing here, but it came all the way down here. What happened? Buyers pushed the price up, right? And it ended up closing here. Now this is a green candle and a bullish candle. It opened here. It first of all came down here. What happened is buyers pushed the price at that same region to close all the way to this top. All right, so you find this again towards the end of a downtrend, signifying that there's a potential shift in market structure. Morningstar is a potential bullish reversal candlestick pattern made up of three candlesticks, which happen towards the end of a downtrend, signifying that there's a potential shift in market structure. So to identify a Morningstar, have a strong bearish candlestick coming from a previous downtrend, and you have your indecision candlestick, which is your doji candle, towards the bottom of this candlestick, of this red candlestick. You have a strong bullish candlestick pattern. that happened after that indecision candlestick, signifying that there's a potential change in market structure. Now you have 3 stars in the south, which are also potential bullish reversal patterns, which happens towards the end of a downtrend. There are 3 bearish candlesticks that happens towards the end of a downtrend, so signifying that bearish momentum is slowing down. How can you identify this? You see this towards the end of a downtrend, where you can see a significant reduction in the body of the last 3 bearish candlesticks the week below previous lows of these candles, right? Like you can see right here, this one has a little bit greater body followed by this low, and this one has a smaller body than this followed by this low. This one has even a tiny smaller body followed by this low, and you can see that okay, this happened towards the bottom of a trend, signifying that there's exhaustion, signifying that every time this come here there were buyer trying to push it up. This will fade out to probably this, probably next becomes green, so it happens towards the bottom of a downtrend. Okay, so as we've talked about these reversals, these bullish reversals, the reverse is true for bearish reversal patterns. All of what you've heard me say here, the reverse is true for this. Let's talk about bearish continuation pattern, right? Let's talk about bearish 3 line strikes. Okay, these are bearish continuation patterns that happen in an existing downtrend. That means there already a downtrend that is happening before you can identify this, right? So how do you identify this? When you see a 3 bearish stick candlestick followed by a 1 bullish candlestick that engulf the size of these 3 candlesticks, this happen in a downtrend. When you see this, you know that the trend is going to continue to that same direction. Have your falling 3 method, and this is a bearish continuation pattern that is made up of 5 candlesticks that happen in an existing downtrend. And how can you identify this? You'll see a 5 candlesticks which is made up of 2 strong bearish candlestick patterns and 3 green candlestick that form between the high and the low of the first candlesticks. And the last one, which is the 5th candlestick, must close at or below the first candlestick. All right, so that is how you confirm that when you see this, you know that there's going to be a continuation in a downtrend. And you have your bearish marker, which is also a bearish continuation pattern that is made up of 5 candlesticks that happen in an existing downtrend. Unlike this one, it looks almost the same, but there's a little bit slight difference. It's also a 5 candlestick pattern, is 1 strong bearish candlestick, which is the first one, followed by a gap that starts a little bit below the low of the first candlestick, followed by the second one. Doesn't really matter what these 2 are, which color they are, but just make sure they don't close below the first candlestick pattern. Stick must close below the low of this candlestick, signifying there's a continuation in the downtrend. And the reverse is true for the continuation of this bullish continuation candlestick pattern. Guys, let me know what you think about this video. Let me know what you think about more tips like this for continuation for you as a beginner. Let me know if you learned something from this. Let me know what you want me to do. The more stuff I see in the comment section, that is what I will do. And hopefully I added something to your trading knowledge. And see you guys. Turn on the post notification so that you'll be the first to see the next video. Peace, love you guys.